Hi friends, welcome to Insurance Decoder, and in this video I will discuss about the e-term plan by India First Life Insurance Company. This is the cheapest insurance term plan available in India. Friends, as usual, we will provide the complete information about this term plan with very easy language and suitable examples so that you will get the complete clarity about the plan. If after that you can decide whether you want to buy this plan or you do not want to buy this plan. We are not promoting any term plan. We are not promoting any insurance policy. These videos are for explanation only. Now first talk about the company. This India First is promoted by Bank of Baroda and Andhra Bank and Carmel Point Investment India Private Limited. Andhra Bank subsequently merged with Union Bank of India. So right now it is promoted by Bank of Baroda, Union Bank of India and Carmel Point Investments Private Limited. This company started its function in November 2009. So it is not a new company. It's a quite old company, a decade old company. So we can trust on this company's functioning. Then comes about the eligibility of this e-term plan by India First. And first and foremost, eligibility that you should be at least 18 years old to buy this term plan, and you should have some income source to buy this term plan. Maximum age at entry is 55 years, so you have the window from 18 years to 55 years to buy this term plan. And the maximum age at maturity is 80 years. So if you want to protect yourself, you can protect yourself up to 80 years of age. If you want to buy protection for longer plan, then you should pursue with other insurance companies. Minimum sum assured they provide is 50 lakh that you will have to take. There is no term plan below that. If you want to go below term plans, then you should go for the Saral Jeevan Bima policy. And the maximum sum assured, there is no limit. However, the maximum sum assured is decided depending on your income. Premium frequency can be monthly, quarterly, half yearly and yearly. Depending on your requirement, you can decide which frequency of premium you want to opt for. And then premium paying term, same as policy term. So if you are having the policy of say 10 years, then you will have to pay the premium for 10 years. And if you want to opt for the policy for 5 years, then you will have to pay premium for 5 years. Minimum term you will have to take the policy is 10 years and the maximum term is 40 years. So for the policy term, you have the window from 10 years to 40 years. Now let's talk about the features of the policy. This policy provides you various options like life options, the income benefit option, income plus benefit, income replacement benefit, and increased sum assured. So these are the 5 options available with this policy. We will discuss about each of them in detail with examples so that you will get to know that which option is best for you. Now let's first see the life benefit option. This is the purest term plan. So the term insurance will be given to you depending on your sum assured requirement. So if the policyholder dies, then the family gets the sum assured amount. Suppose somebody has taken a term plan of rupees 1 crore and policy is still 80 years. So if the person dies up to 80 years of age, then his family will get complete sum assured amount, that is rupees 1 crore. In our case, say the person dies at the age of 75 years, then his family will get the entire sum assured amount, and that is 1 crore rupees. So it is the purest or plain vanilla term insurance plan. No riders, nothing add-on, simple plan. Now then comes the second plan, which is the income benefit plan. In the income benefit plan, what happens, the 10% of the sum assured is paid to the nominee on the death of the policyholder. The remaining part, 90% of sum assured, is paid to the level income during 5, 10, 15 and 20 years to the nominees. So it depends on the kind of option the policyholder opted for. If the policyholder opted for 5 years, then the 10% will be given in at the death of the policyholder, and the remaining the amount will be given in the installments. For example, like the previous example, we will take the sum assured as 1 crore and policy is for 80 years, and the person has opted for 20 years option. So in this case, the insured person dies at the age of say 75 years, then insurance company will give the 10% of the sum assured, that is 10 lakh rupees, to the family members or the nominee on the death of the policy holder. Now the remaining amount, that is 90 lakh rupees, will be given to the family members in monthly installments for 20 years. That means for 240 installments, this 90 lakh rupees will be given. So this is a kind of income benefit. So family will be getting a regular monthly income for next 20 years after the death of the policy holder. This plan is very good if you feel that your family will not be able to manage 1 crore rupees. Friends, many times we feel that if we have taken the policy of 1 crore, it will be good for us, but we have to consider the financial literacy of our nominees, whether they are financially literate enough so that they can manage this big amount. Generally what happens, people spend these 1 crore or whatever the amount very easily, and after 2, 3 or 4 years they will not be having anything with them. So this kind of benefit is very good if the kids are very small and wife is housewife, she does not understand about the financial concepts, about the interest and all these things. If she does not understand, then you can opt for the income benefit kind of options. Then comes the income plus benefit. Here what happens, the first option is given 100% of the sum assured is given on the death of the policyholder, and the remaining 100% will be given in the installment. So here the double benefit is given. First sum assured amount is given on the death, and the second sum assured amount is given in the installment. So here the premium will be higher. If you are opting for different options, then premium will be higher. It is not like that in the option 1, 2 and 3 premiums are same. Premiums will keep increasing because here you are giving 200% of sum assured. That means double sum assured you are giving. So in this case, premium will be higher than the previous two options. How it will function, let's see. If the sum assured is say rupees 1 crore and policy is taken till 80 years, and the person opts for 20 years this option. Now what happens if the person dies at the age of say 75 years, then the insurance company will give 100% of the sum assured to the nominee on the death of the policyholder. So that is 1 crore rupees will be given to the policy, to the nominees on the death of the policyholder, and in addition to that, this 1 crore will be again given in 20 installments. So here effectively 2 crore rupees will be given to the family members. So this 1 crore, the remaining 1 crore will be given in 240 installments. The next option is income replacement benefit. In this option, what happens, the amount equal to monthly income is paid by the insured company till policy term after the death of the insured person. So it is a kind of income replacement due to death of the policyholder. Policyholder was earning some amount on monthly basis. If policyholder dies, then that monthly amount which the policyholder's family was receiving from the company or from the organization where the policyholder was working, that amount will stop coming. Now, to replace this monthly income, the insurance company will replace the monthly income through the insurance policy. So because of that, this is called the income replacement benefit. So the amount equal to the monthly income which will be paid to the policyholder till the age of the retirement of the policyholders. So say if person earns monthly 1 lakh rupees and policy till 80 years, and insured person dies at the age of 65 years. In that case, for the remaining 15 years, the insurance company will keep giving the family 1 lakh rupees for next 15 years. So they have replaced the income which has stopped because of the death of the insured person. So this is called the income replacement benefit. And the next option comes is increased sum assured. So up to age of 55 years, on following reasons, the insured company will increase the sum assured. There are certain events in our life which requires additional sum assured, because when we have the increased liabilities or increased responsibilities, we need more money to protect those responsibilities. So the India First provides you this opportunity wherein you can get the increased sum assured option. So when you get married, the insurance amount will be increased by 50%. Suppose you have taken this 1 crore sum assured, so you will be given additional 50 lakh rupees sum assured. So now after marriage, your sum assured will be 1 lakh 50, 1 crore 50 lakh. On your birth of your first child, you will be given additional 25% of sum assured. So 25 lakh rupees will be added to your sum assured. On your second child's birth, you will be given additional 25% of sum assured. So after your marriage, your first child and second child, your sum assured amount will be doubled. So this option is helpful if you are unmarried, you want to opt that in the future. When you get married and you will be having children, you will not be searching for other insurance, and you want to protect the increased premium, because if you take it right now, the premium will be fixed throughout the policy period. It will not keep increasing. So if you want to go for it, you can go for it. It is not mandatory. You can also go for plain vanilla option. Similarly, they also provide you the home loan related term plan also. So if you have taken a home loan, then the additional cover will increased by equivalent to your home loan amount. So these are the 5 options available with India First option or India First life insurance policy. You can check depending on your requirement. You can also read the brochure for details. And now comes to the things to know. There will not be any kind of maturity benefit because this is a term plan. For the term plans, no maturity benefit is given. Grace period will be 30 days for yearly, half yearly, and quarterly premiums. Grace period is nothing but the additional time period given to you for payment of the premium. If person dies during this grace period, the insurance company will pass the claims. And if you have opted for the monthly premium options, then the grace period is 15 days. Surrender value, if you are going for the regular premium, there will not be any kind of surrender value, and you cannot take loan against this policy because as usual, there are no loans against any term insurance policy. However, if you have opted for the single premium, then there will be some surrender value will be given to you, and this is the formula to calculate the surrender value. And there will be a free look period of 30 days, and policy revival will be given in 5 years. So if because of any reasons, if you have stopped paying the premiums and after some time you feel that you want to continue the policy, so you have the 5 years time from the last premium payment. Within that 5 year window, you can go to the insurance company and you can pay the remaining due premiums with interest, and then the policy will be reinstated. So that period is given 5 years. This is called the policy revival period. As far as the riders are concerned, this policy provides you the accident shield benefit rider. So if you want to protect yourself against the accident, you can take this rider. Then disability shield benefit rider. For the permanent disability kind of things, you can buy this rider. Critical illness protection rider. So to protect against the critical illness, you can opt for this riders. Details of these riders you can read on the insurance policies brochures. And it also provides you comprehensive benefit riders, which combines of a combination of accidental death and accidental terminal and permanent disability rider and critical illness rider. So you can opt any of these riders, or you can opt one or two or three riders. Now we talk about the premium. So this is the online term plan. So you can go to the India First website and you can click on these details, and then you will get to know the premium. So for the birth of, I have taken the date of birth 13 July 1990 and no smoking, male. And then we calculate the premium. The premium comes as if you are opting for 1 lakh 1 crore rupees, the premium will be 719 rupees per month, inclusive of applicable taxes. And if you want to go for annual premium, then this premium will be 8,260 rupees. So for 8,260 rupees, you are getting 1 crore rupees term insurance plan, which is quite a good deal. Now, how to buy? To buy this insurance policy, please visit to India First website. From there, you can go and buy this insurance policy online. There will not be any kind of commission of the agents and all these things. Don't go through the intermediary directly. Just if you want to buy, you should buy always from the insurance company's website, whether it is India First or HDFC or ICICI, whosoever. Everybody sells the insurance online, so it's always better to buy online from the insurance company's website instead of going through other agents or through other media, because then there will be direct interaction between you and the insurance company. You will not have to communicate to the insurance company through those intermediaries. Now let's talk about the solvency ratio. These are the numbers which are very important. Solvency ratio is the prescribed solvency ratio is 1.50. So outstanding claim against you have at your equity or your net worth, that is 1.5 is prescribed by IRDAI, and the solvency ratio for India First is 1.74%. And as far as the claim settlement ratio is concerned, it comes 92.82% for 2019-2020. And this is taken from IRDAI's website. So there will be a concern maybe coming in your mind that the claim settlement ratio is a bit low compared to the other insurance companies like HDFC and all these things. Their claim settlement ratio is 92.82%. So here thing is that generally this is my personal kind of research. There is no backing of it. However, on my personal experience, I'd say that since this policy is very cheaper and people will buy it, and there will be some fraudulent things also be happening over there. Because of that, the claim settlement ratio is a bit low. However, for the genuine claims, insurance companies generally do not reject claims. They will definitely settle the claim, and many a time I have receiving emails and comments on my channel, and people keep asking that their claim was rejected. And when I asked them why the claim was rejected, they said that their father, brother, or whatever, they died because of cancer. I said that whether this was disclosed to the insurance company. They said no, this they did not disclose it to the insurance company because they were not aware of it. It cannot happen. If a person has cancer, why he will not be aware of it? And after taking just the policy, and within 1 year or 2 years, if the person dies, it is hardly case scenario that person was not aware of it. So always tell truth to the insurance company, then chances of the claims rejection will be very less. And the section 45 also comes into the protection. So if you have paid the insurance premium regularly for 3 years, then the IRDAI said that insurance cannot be rejected on any ground whatsoever if the person has paid the premium for 3 years continuously. And thereafter, if the person pays the continuously premium, then insurance claim cannot be rejected on any ground whatsoever. So this is a big protection to the policy holder. Now, as usual, I say never forget things. So always fill the policy application from yourself. Never give it to the insurance agent, because you know about yourself more than anyone else. So always fill the proposal form for the policy application on your own. After receipt of the policy document, read all the terms and conditions, inclusion and exclusion carefully. And if you agree with those, if you like them, if you feel that they are the same you were explained before buying the policy, then only keep the policy. Otherwise, you have the option to surrender the policy during the free look period, that is 30 days. So if you surrender the policy within that free look period, then the claim will not be, then the premium will not be deducted. They will pay you the entire premium back. However, they may deduct the stamp duty which they have paid for the policy document, and they may also deduct the medical test charges if they have conducted any medical test. So these charges may be deducted. Otherwise, the remaining amount will be paid to you. So these things shall be clarified within first 30 days. If you have clarified those things, then you shall continue with the policy and you can keep paying the premium. Friends, that's all for the India First e-term plan. I hope you have liked the video, and if you have liked the video, please don't forget to like it. And if you are not subscribed to my channel, please subscribe to my channel for better videos, for insurance exclusive videos in English only. And friends, for your patience, for your thanks, for your for watching the videos, thanks a lot.